Hello everybody. In this tutorial today I'm going to talk about some of the risk models for high frequency trading and understanding dark pools. Now this is a tutorial based upon the course MATLAB for financial engineering that I have been working on, and this is for education and research purposes only. So here we are going to talk about some of the developments in the high frequency trading world, and we are going to look at what does dark pool mean. Uh, this is basically a study which is kind of risk management for prime brokers. Don't worry if you have never heard this term, we are going to go through them one by one. So dealer bankers are the banks that provide various services to the hedge funds and to other companies. They provide like OTC deal, they provide prime brokerage services to the hedge funds, they provide all kind of those exotic things that uh, that the retail bank does not provide. So dealer banker takes care more or less about those things. In this tutorial I'm going to look at topics pertinent to high frequency trading and dark pool. So we'll be talking about the current challenges that exist in the system. We are going to also look at shadow banking, emerging risk, rehypothecation, counterparty risk, and qualitative and quantitative models for prime brokers. Now we are going to look at also the current literature that exists on the risk that we have in the high frequency trading world. So something which is still researched a lot. So prime services or prime brokerage refers to the services provided by the dealer banks to the hedge funds, and most of these services include high frequency trading, uh, risk services, and such kind of a things which the hedge funds want to play around with. So that's one part. Now if you have not heard the word dark pool before, you can check out my earlier video, but what dark pool essentially mean is anonymous trading. So you don't get who is trading on the other side, you don't get how big the order is, and you really don't know. So it's a dark space where you have to throw in an order and it will be executed if it matches some order, it will be not executed if it does not match any of the orders available there in this dark domain. So this was essentially important because whenever there is a big event, or whenever there is someone who wants to buy in some stocks, or who want to make a big order in the market, he would be challenged with people who are going to suddenly rise the prices at that particular time. So whenever pension funds or other big funds, or like ETFs uh, which rebalances essentially each quarter, and whenever they came to the market, they see that suddenly the prices were moving a lot of up, so they were driving prices a lot. So in the dark pool they can trade anonymously without showing any information about themselves or their order. So in that way dark pool become very important. Now high frequency trading, as the name suggests, it's trading at a very fast speed, and that is one reason that risk has increased a lot here. So what has become interesting here is that now the risks have to be dealt in real time, and we cannot wait for a lot of time. So there is a limited literature on how to work around with this risk. Now there are issues of routing orders in a dark pool and again back into the exchanges. So there is literature available on that part, but essentially a lot of research needs to be done on how we need to approach this area. So to start with, I'll start with the broadest term here. So the broadest term is dealer banking or shadow banking, which refers to the non-bank financial intermediaries that provide services to hedge fund, money market fund, structured investment vehicles. So prime brokerage is a part of it that generally takes care of the hedge funds. So when we talk about these dealer banks, the main risk that they face is custodial risk, like they take a custody and uh, they rehypothecate it or reborrow it to make another trade out of them. So that's called rehypothecation, uh, also known as custodial risk, and there is a ripple effect of that. In US, the rehypothecation allowed is 1.6 times, so after that it stops. And this is one of the reason how the mortgage papers went around with one bank to the other, and that caused a ripple effect and increased the systematic risk. So that's one aspect of risk. The other aspect again from the same comes as leverage. Then we have the interest rate risk, because most of the times these shadow banking involves selling all those interest rate collars, hedges, and these kind of instruments. So that was interest rate rates, and a little related to the same is the currency risk. So these are the prime risk and the prime concerns that the dealer banker face today. So currently we use Basel norms to calculate the market risk. We have Basel 3 into the implementation, which uses various risk parameters in the market risk, but the shortest duration is the day. So whatever happens between 1 day or 1 minute or 15 minutes is not counted here. So for all kind of risk that are involved here, uh, all kind of risk in these OTC deal, all kind of risk involving the counterparty risk, all of that are taken care on daily basis. So there is no mechanism put into place to help understand bank to avoid the new risks that exist in the world today. So coming back to a specific area that we are looking here, they are the dark pools and the HFT. I'm talking dark pool because a lot of trading, around 30% of trading is moved into the dark pool. Algorithmic trading is moved there. If you think somebody can play around with the prices on the exchange, you can search for a better price on the dark pool. When there are big executions, it's mostly available in the dark pool. So there are some literature that says that the retail investor is not able to sell things at the right prices because sales go through the dark pools. But on the other hand, there are advantages of having these dark pools, that the prices are not drawn up immediately. So and there are algorithms that go and ping around in the dark pool to find really what price is available there, and take the arbitrage from the exchange and the dark pool. So that's one area that's being researched a lot. But most of the things that goes here is the classical way, or the OTC. So the dark pools, the high frequency trading is bringing into the world new risk that we saw in the night capital, that we saw in the flash crash. But the current market risk mechanism does not takes care of that. So if there is a trade like that happened in the night capital, or that happened into the flash crash, or that happened when